Good afternoon and welcome to the Bills and Sundberg General Counsel Series. My name is Scott Baina and I am the chair of Bills and Sundberg's Business Finance and Restructuring Practice Group, and I will be moderating today's program on select topics in loan restructurings. For the benefit of those we haven't had the opportunity to work with, Bills and Sundberg is a full-service commercial law firm based in Miami, Florida. The firm is generally regarded as a go-to resource in South Florida for businesses and institutions alike, looking for business-minded solutions to legal matters and to avail themselves of our knowledge and stature in the legal and business communities in this region. The Business Finance and Restructuring Group is a pillar practice group at Bills and Sundberg. The group is consistently ranked at the top of its peer group for its expertise in commercial lending, creditors' rights, workouts and out-of-court restructurings, bankruptcy and bankruptcy litigation. The group's clients especially benefit from the fact that each of our partners had prior experience in business, finance, accounting, or banking. While the current climate for business and business credit would appear to be robust, commercial loan defaults persist and may well proliferate as loans age and macroeconomic conditions inevitably change. Moreover, numerous business segments like retail, healthcare, and print media are lumbering despite the general uptick in business. The fact that bankruptcy filings are generally down is an inconclusive metric, since it more likely means that bankruptcy is simply not presently regarded as a viable restructuring option for a variety of reasons that are beyond the scope of this program. The point is that we believe it is useful to provide corporate counselors such as yourselves with an update on restructuring dynamics, pitfalls, and strategies. Our first speaker is Robert Siegel. Bob leads our commercial finance practice. He represents lenders and borrowers alike in the full array of commercial loan transactions at every level in the cap deck and in respect of originations as well as restructurings and the resolution of intercreditor disputes. Bob will address the implied obligation of lenders to act in good faith, particularly in the context of loan workouts. Bob.
Thank you, Scott. Every contract, whether consumer or commercial, has an implied obligation of good faith and fair dealing. The sources of the obligation are the UCC, particularly for loan transactions, and the case law that has emerged in virtually every state. The decisional law varies and, of course, is extremely factually based. But one cornerstone of the analysis is, has the lender's acts or failure to act deprived the borrower of the benefit of its contractual bargain under the loan documents? And from the lender's standpoint, the issue becomes, can it rely on the terms of its agreement that it's negotiated with the borrower? And from the borrower's standpoint, often it becomes an issue of whether it can bolster its position based on the lender's actions in the course of effectuating a workout, or occasionally even prior to the commencement of a workout. Historically, the cases have favored the lenders, and since the Great Recession, while there's been a flurry of decisions, the good news for lenders is the cases generally continue to favor the lenders, and there's really substantively not much of a departure from the pre-recession law. For the litigators in the audience, the states vary on whether a breach of the covenant of good faith is an independent cause of action. For example, in Florida and many other states, the answer is no. And in New York and other states, the answer is yes. But in reviewing the cases, it becomes clear that notwithstanding that there's a separate cause of action in New York and these other states, there really doesn't seem to be much of a substantive difference in the way the cases come out. Of course, there are procedural differences that would be encountered. The takeaway from these cases is that good faith obligations do not, at least without more, override the express terms of the loan documents. courts tend to allow lenders to exercise sole discretion and similar absolute rights. But like everything else, there's a caveat. Banks' rights are always going to be balanced against the borrower's ability to get the benefit of its bargain in the loan documents. To illustrate, the provisions in a loan agreement providing for an accordion or a facility or for a loan extension should allow the lender to be able to refuse to lend for any reason, assuming, as most loan documents provide, that the language says sole and absolute discretion of the lender. In part, I believe that's because the borrowers, as a commercially reasonable standard, should have no expectations based on commercial practices generally that if there's an option to renew that's in the favor of the lender, that they're necessarily going to receive the benefit of that option. In contrast, the imposition of a reserve by an asset-based lender, which typically has the ability to impose reserves relating to the collateral, and the language does say sole and absolute discretion. It says that there does not have to be a particular reason, but I think a lender needs to be careful in those circumstances. Imposing a reserve for no particular reason would tend to raise red flags, whereas commercially reasonable interpretation of the reserve is to allow the lender to impose a reserve in its absolute discretion in circumstances such as when an account debtor is in financial extremis or bankruptcy or something of that sort. And the reserve is tied to an event that the lender can point to, and it's the type of event that other lenders in the commercial finance industry would tend to impose the reserve themselves. The issue for a lender in exercising its rights is more focused on how and when the rights are exercised rather than whether or not the rights can be exercised in the first instance. The two cases noted on the slide indicate that a lender normally has a right to foreclose upon a default, and a lender isn't required to extend a loan under the loan documents. But on the next slide, you'll see that there could be other conduct that creeps into the exercise by the lender of its rights and remedies that exacerbate the situation. Actions such as delays in pursuing rights or failing to respond timely or responsively to borrower's inquiries and raise red flags that call into question the manner in which the right that the lender did have to take certain action, whether or not that right was acted upon in good faith. So basic questions include, must the lender negotiate with a defaulting borrower? And from the cases, the answer is generally no. But the lender should base its decision on the economics of the situation. The lender should also be willing to speak with the borrower. A lot of this is just common sense, but considerations to take into account should be the nature and severity of the default, i.e., is it a material default? Lenders should take into account the borrower's conduct. For example, if there's a fraud, that's a very good reason, obviously, to be immediately exercising rights and remedies and curtailing your interaction with the borrower at that point. Another consideration is the likelihood of successful rehabilitation. If a lender genuinely believes that the borrower cannot be rehabilitated, there is no upside in it negotiating with the debtor. That doesn't mean the borrower should ignore the debtor or not be communicative, but it should be acting to pursue its rights and remedies to maximize the value of its investment. Things to avoid include negotiating without actually intending to reach an agreement, delaying and responding to the borrower, or being unresponsive. The other side of this is the lender does not have to stop exercising remedies as a matter of a determination of good faith. The lender should be entitled to not have lost time if it's negotiating good faith with a borrower because the next inquiry is, do you have to reach an agreement if you agree to negotiate? And the answer is no. So if you're negotiating in good faith, you're trying to reach an agreement, but you don't, as a lender, genuinely think that the deal is going to work, then you want to be down the road. If you're foreclosing judicially, for example, you want to have filed your lawsuit and be in a position to finish the litigation process quickly to protect not only your rights, but to maximize whatever return is left for the borrower. That said, we suggest in all cases that before you start a workout with a borrower, you need some sort of a pre-negotiation or forbearance agreement. And this should happen before there's any meaningful discussions with the borrower. The slides above are a laundry list of the considerations to be addressed, so I won't read them to you, but I want to address a couple of points. First of all, the defaults of a borrower should be acknowledged by the borrower, and the borrower should also acknowledge the materiality of those defaults. A lot of the litigation in these cases is based on a lender taking precipitous action based on a default the lender might think is material, but the borrower does not. So it's very helpful to get the borrower to acknowledge and agree that the default is material.
Bob, if you don't get such an acknowledgement, are you suggesting that the negotiation not go forward?
No, I think you sort of have a duty in any regard to negotiate with the borrower, but you're also at the same time, whether you have a forbearance agreement or not, going to not want to put anything out there, whether orally or in writing, that you wouldn't agree to do in a formal letter to the borrower offering a restructure or whatever it is that's the subject of the letter. But I think you do have an obligation to speak to the borrower and respond in any respect. These are the things that you want to get if possible. Defaults also should be acknowledged by the borrower, and the borrower should further state what defaults it knows of. It may turn out that there's plenty more defaults than the one that the lender happens to know about, because often the lender's the last to know about these things. But as a drafting consideration, it's very important. It's one thing to say, well, there's going to be a forbearance for until a date certain, but if a default exists that no one knows about, or a new one arises, the lender certainly wants the ability to shorten or end the forbearance period. The other aspect of forbearance agreements that ought to be considered is the use of terms such as materiality or material, reasonableness. They're less important to a judge in a forbearance agreement, and a lender should want to avoid agreeing to include these terms that lawyers invariably ask for almost as a knee-jerk reaction. There's been cases where judges have ruled that in a forbearance agreement, the lender's risk of loss is heightened, its expectations are lowered, and it's not ordinarily obligated to negotiate. So the judges tend to strictly construe the forbearance or workout agreement or restructure a lot more rigorously than they would the original agreement. The other aspect of forbearance is the releases. The releases are an issue that becomes a hot button early on. Every lender asking for a forbearance is going to want to release. Every lender that agrees to a forbearance is going to want a release from the borrower of all its claims and defenses. Of course, the borrower has the claims and defenses as pretty much, oftentimes it's only leverage. And there has to be some sort of a give and take. In certain instances, if, for example, I had a transaction, a multi-billion-dollar workout where a lender was willing to give us a 10-day forbearance, in that instance, it was clearly not a fair trade-off on the part of the borrower to waive his claims and defenses, and In fact, we did not. On the other hand, we got to the point where we had a 30-day forbearance in that transaction, and the lender had agreed to negotiate and work with us to reasonably come up with a resolution. And at that point, in part because we didn't really have any claims and defenses that we could think of at the time, we traded that off for what we thought was real value. So a borrower has to keep in mind that the release, or the dive as it's called, is valuable and should be used judiciously. I'll say on the 30-day forbearance, had we had a defense, I would be surprised or shocked if we had agreed to the 30-day and waived our claims at that point.
Bob, is it fair to say that the case law doesn't provide a bright line test for the appropriateness of certain give-ups based upon certain time periods?
That's absolutely right, Scott. The concern, too, in a forbearance, because you're not at the restructuring stage, is consideration. And if you're getting, as a lender, requiring a dive for a 10-day, as I used in my example, forbearance, it's very likely when the court, presumably a bankruptcy court, looks at that, they're going to find issues. So, yeah, it's very important. It's the give and take, and it's the consideration aspects that are key in these forbearance agreements.
Does a borrower's willingness to give up certain protections in bankruptcy likewise get measured by how much the lender is forbearing for?
I think that's right. But again, it's a slippery slope in these cases, as all of this is determined by what is the latest decision in your jurisdiction. So what we're trying to give you is principles to, and this is one of them, that there has to be a give and a take, and there has to be a thought to what value are both sides getting, so that the deal is likely to be upheld in a bankruptcy or in a litigation scenario. Even with the forbearance agreement in place, it's still important to keep in mind that you don't want anything to be put in writing or said orally that you're not willing to agree to at that moment. And I put in a short piece on emails because, of course, that's the way everyone does business today. And not surprisingly, since the recession, there are some cases that say that an email can be deemed to be a modification of a contract. It's deemed to be a signed writing if it's coming from the two parties that are negotiating the deal. So a lender has to be very careful about its emails. Basically, it wants to paraphrase or put into writing what the borrower tells it, and anything it says, it has to not say it in a way that it's going to be bound by the correspondence. On the other hand, with emails, there's even internal emails between lenders or in a lending group or lenders inside the bank, banking officers. Those emails become great evidence in these lender liability cases. I'm sure everyone has read the newspaper about the Wall Street emails that have the officers at these firms calling their product that they're trying to sell to securities investors pigs, dogs, and worse. And even lawyers have had problems and been ensnared in the email trap. Recently, there's a case involving internal emails amongst lawyers looking to work on a certain matter and looking forward to the feeding frenzy. However, unfortunately for these lawyers, the client, had sued the lender for excessive billing, and I think they settled right after that or are in the process. The other issue that becomes important in a workout in particular is the issue of control. Once the lender is concerned about the economics of the deal it is almost instinctive that the lender is going to want to know about everything, and if it could, it would like to run everything at a certain point. And that's where good faith comes into play, and the test is you really do not want to put yourself in a fiduciary position with the borrower. And fortunately, according to the case law, it takes some doing to get there. But certain principles to be guided by are fleshed out by example. If a borrower is having problems with his operation, it is likely to be perfectly reasonable for the lender to insist that the borrower's officers, the senior officers' salaries are curtailed or even not paid, or the distributions are halted, or the payments are just not going to be made going forward, especially if the borrower is a guarantor. If the borrower's officers are guarantors of the loan, I think that would be an exercise in good faith. However, deciding that the borrower should fire certain people is drilling down into the operations of the borrower, and in that case, the lender should be more circumspect and more sticking to the operation of its loan as it relates to the borrower's operations, not to direct the borrower's operations. Deciding the overall budget is excessive, that is one thing, and that's perfectly permissible. But once the lender decides who gets paid and how much, not only is it likely to have issues with the borrower, but it's going to have issues with the other creditors, particularly, obviously, those who don't get paid. Consultants, a similar issue. It's perfectly reasonable for a lender to insist upon a consultant being engaged in a workout. It's done all the time. But where the lines start to blur on the good faith issue is when a lender has the consultants reporting directly to it, or the consultant is coming in and replacing the current management or business owners. Lastly, I'd like to talk about a little-known statute, in part because it's buried in the middle of the usury section of the Florida statutes, which is Chapter 687, and that is what I refer to as the credit agreement statute. Basically, it says that agreements in Florida with a lender and a borrower must be in writing to be enforceable. So if the borrower has an oral promise, in Florida at least, it's almost a statute of frauds type statute, the obligation is not going to be enforceable. Now, I wouldn't recommend not getting a forbearance agreement and doing all of the other things we discussed, but it's certainly handy to know if you have a Florida transaction that statute's out there and can give you protection. And the borrower should know it's out there, so the borrower insists on getting everything that the lender agrees to memorialized in writing.
Bob, does the obligation of good faith vary if, in addition to giving a forbearance, the lender is also being asked to and is willing to make further advances?
I think so. The further advances comes into the context of the sole and absolute discretion. I think if a lender stops making advances in that scenario, it's going to get an awful lot more, the judge would be more favorably inclined in that situation for a lender to cease to make advances. There was a case out there recently on a condo where a condo development, and the borrower had failed to meet its sales expectations. And the forbearance agreement provided for certain sales over a certain period with targets. And going forward, the borrower made its sales but came a few units short in meeting its expectations. And in fact, it received or made the additional sales within weeks of the deadline. But in the meantime, the lender foreclosed, put the borrower out of business, and the court held that when it comes time to the forbearance period or the workout period, all bets are off, and the lender's entitled to require or entitled to have its deal strictly construed.
Thank you, Bob. The next segment of our program concerns the so-called hot-button issues of default rate interest, late charges, and prepayment fees and premiums, as well as strategic considerations from the differing advantages of lenders and borrowers. Our speakers are Jay Sacolo and Jeff Snyder. Jay has a diverse practice that covers the waterfront of lending and creditors' rights. He's had an especially active year during which he closed more than $1 billion of transactions, as well as having served as lead counsel in several closely followed contentious bankruptcy reorganizations. Jeff is a sophisticated restructuring lawyer who has had ample recent experience litigating the very hot-button issues he'll be discussing with you. In fact, he is presently before the 11th Circuit Court of Appeals on the issues of default rate interest and late fees in the context of Chapter 11 plans of reorganization that reinstate pre-petition loans. Jeff?
Thank you, Scott. The starting place in any negotiation is, of course, the loan documents and the relative strength or weakness of the legal positions of the respective parties. And default rate interest, late charges, and prepayment penalties are among the issues that are most often the subject of both negotiation and litigation. And so we'll discuss generally the legal considerations surrounding this issue, as well as how the threat of bankruptcy filing impacts each. In addition to understanding the range of possible litigated outcomes and thus the best and worst case scenario, which provides the contours for any principal negotiation, it's also important to understand who's on the other side, what they stand to gain or lose, what authority they bring to the table, and what may be motivating them that is not always readily apparent. And we'll come back to that after we discuss the legal considerations. Starting with default rate interest. Default rate interest is often an emotional topic for borrowers, as it can be a large number and it can be viewed by a borrower as a lender taking advantage, where, of course, a lender sees it as compensation for not repaying the loan as agreed and would probably argue that absent default rate positions, pricing would be higher for everyone in the marketplace to compensate for the risk that some loans are not going to perform. The allowance of default rate interest is an analysis that's largely driven by state law, and there are two approaches. The first approach, which is the majority view and the view that's followed here in Florida, is what's referred to as the usury approach, and it really just asks the simple question of whether the default interest provided for under the contract exceeds the usury caps provided for under state law. For example, in Florida, 18% for loans up to $500,000 and then 25% for larger credits. There's not a single reported case in applying Florida law or in Florida that refuses to enforce a lender's contractual entitlement to non-usurious default rate interest. So the usury approach is the majority approach under state law. However, there are several states that still apply what's called the liquidated damages approach. For example, Massachusetts and I believe Illinois apply this approach. It basically disallows default rate interest that is punitive and requires some demonstration that the default interest approximates the loss that will be suffered or that's expected to be suffered as a result of the default. It's generally the burden of the borrower to show that the default rate interest under the contract is not compensatory. Really, that's the breakdown of how state law approaches default rate interest. But I would add the additional comment that once a note is liquidated into a judgment, generally the statutory post-judgment rate is what is applicable from and after the point that the judgment is entered, and that's often a very low rate. In Florida, currently it's 4.75%. For a federal judgment, it's actually currently 0.14%. This varies from state to state, but in Florida, the law permits and Supreme Court precedent supports enforcing a specific provision in a note that specifies expressly a post-judgment rate. For example, I was involved in a case where the post-judgment rate was expressly set forth as 24%, which is a very substantial difference than the post-judgment rate would have been under the statutory rate. A negotiation after a default always contains the possibility that it may trigger a bankruptcy. And so the impact of a bankruptcy on the entitlement to default interest is important to consider. And the answer is generally very straightforward with respect to the entitlement to default interest for up until the date of the bankruptcy filing. It's basically the analysis that I just went through. It's determined by reference to state law. So to the extent it's that the Yuzuriha Proach or the liquidated damages analysis that varies from state to state. That's all incorporated under Section 502 of the Bankruptcy Code. The issue gets more complicated with respect to the accrual of default rate interest or interest at all post-bankruptcy. As a general rule, interest is not allowed post-bankruptcy except as provided under Section 506B, which allows an oversecured creditor interest in reasonable fees and charges only to the extent of its security. I say generally because there are potentially other instances where interest would at least arguably be due, such as a plan that would propose to cure all defaults under Section 1123D of the Bankruptcy Code. That provision refers to the underlying contract in state law, notwithstanding Section 506B. So where interest, fees, and charges are due to an oversecured creditor, there is disagreement regarding when the amount of the oversecurity is measured. And that's an issue that really only becomes important where the magnitude of the post-bankruptcy interest charges and fees may cause a creditor that's oversecured as of the date of the filing to exhaust its security and become undersecured. In the 11th Circuit, which of course includes Florida, courts tend to measure the amount of security for the purposes of adequate protection during the case as of the petition date and for the purposes of allowing interest, fees, and costs as of the date of confirmation. Most courts, however, take a more flexible approach to this and will measure the amount of security at a time determined by the court based on the facts and circumstances of the case, such as an event that might give rise to a change in value of the collateral. This approach is discussed extensively in the Southwest Boston Hotel Venture case, which is a 2014 case out of the First Circuit referenced on the slide. So, having established that an oversecured creditor is entitled to interest, the question that remains is at what rate? And does a creditor get default interest, non-default interest, or something else entirely? Prior to the enactment of the Bankruptcy Code in 1978, the prevailing case on this issue was the Supreme Court case called Vanston Bondholders. And this case called for a flexible approach that considered the contract rate only as a starting point and called for the balancing of equities to avoid an inequitable or unconscionable result. And so the question is, what did the enactment of the Bankruptcy Code in 506B have on the Vanston approach? In the Ron Pear case, the Supreme Court discussed the application of Section 506B to non-consensual liens, and in doing so indicated that the right to post-petition interest is unqualified and no reference to pre-code practice is necessary because the language of the statute is clear. Nevertheless, most courts have held that 506B is clear to the extent that it allows interest, but not at what rate, and thus the balancing of equities is still the appropriate test. In other words, Vanston is still good law, and these courts generally apply a rebuttable presumption in favor of the rate set forth in the contract, but consider whether a default interest rate is a market rate, whether it's compensatory or punitive, any misconduct alleged on behalf by the lender, and the impact that allowing default interest will have on junior creditors. On this last point, the law is fairly clear, particularly in the Second Circuit, that when a debtor is solvent, default rate interest should be allowed to avoid a windfall to equity. But the problem is that it more often comes at the expense of unsecured creditors, and some courts view it as inequitable to award default interest at the expense of unsecured creditors, particularly when the amount of default rate interest has been allowed to grow as a result of litigation brought by the secured creditor. Some courts, however, have focused more on the windfall that a debtor would receive and award default interest unless they find it to be unconscionably high or inconsistent with the market. The 11th Circuit, however, is a little bit different in this approach. It holds that Vanston was superseded by the enactment of the Bankruptcy Code and takes more of a statutory interpretation approach, looking strictly at 506B and noting that it leaves out the word reasonable before interest, the word interest, but includes a reasonableness qualifier for fees, costs, and charges. And thus, in the 11th Circuit, there's no room for an exercise of discretion, and to the extent allowed under state law and the loan documents, default interest should be allowed. So that really concludes the discussion on default interest. I wanted to say a few words as well about late charges. Late charges are generally permitted to the extent of the missed payment. However, we caution that late fees may be considered interest for the purposes of a usury calculation. It's an issue that's not decided in Florida, and some courts have held that late charges are additional interest, where others consider them to be liquidated damages for the additional efforts of the debtor, or rather of the lender, in making bookkeeping entries, communicating with the borrower, and dealing with a late payment. In states that will take the liquidated damages approach to default rate interest, there are arguments, again, about whether late charges are double counting or potentially a penalty. Once a loan is accelerated, however, the law is generally consistent that late charges can no longer be charged from and after the date of acceleration, because the act of acceleration terminates the regular payment obligation, and indeed most lenders wouldn't accept a payment for a partial payment at that point. So it's viewed as unfair that they would charge a late fee for one having not been submitted. The leading case on that is referenced on the slide, a case called Tavern Motor Inn, and there's Florida authority as well for that proposition. And the filing of bankruptcy, it's a similar analysis. With respect to the amounts that are allowed up to the filing of the bankruptcy, it's a matter of reference to state law. With respect to amounts, late fees that could accrue post-bankruptcy, it would be considered a charge that would be subject to reasonable analysis under 506B if the lender is oversecured and entitled to payment of that amount at all. So it becomes very much an issue that's within discretion of the court.
Jeff, can a lender charge both late fees and default rate interest?
A lender can charge late fees and default rate interest prior to acceleration, at least in a state like Florida. In a state where default interest is looked at as compensatory, it would at least be susceptible, depending on the amount of the late fee, that perhaps the late fee and the default rate interest are compensating for the same loss. In a state like Florida, you can charge a late fee on the specific amount of the missed monthly payment, but once you accelerate the whole loan, there's no regular payment that's due, so there's no ability to continue charging a late fee. And with that, my partner Jay Sacolo is going to talk a little bit about prepayment premium.
Thank you, Jeffrey. Prepayment premiums are, from a definitional standpoint, it's an obligation that is due upon the early redemption or payment of the debt that the borrower has incurred. It exists almost exclusively in the fixed rate environment, and as we have all seen post-recession, we are historically low fixed rate loans. And lenders have imposed, in order to protect themselves against early payment or pre-redemption of those debt obligations, prepayment penalties or premiums, as the lenders wish to call them, to protect them against the lost income that would come from the interest payments due on that debt if they get those loans paid off early and they have to re-let them at a reduced interest rate in today's environment. There really are three different types of prepayment premiums. One is referred to as a no-call premium, which that exclusively prohibits the prepayment of the obligation, at any time prior to its maturity. That being said, sometimes in that situation, you will find yourself as a borrower wishing to prepay it, and it becomes a negotiation between you and your lender about whether they'll allow it and whether there will be a charge to do so. Second type is what's called a fixed rate fee, which is a percentage of the outstanding balance. Typical ranges in this market are anywhere from 0.5 point to 3 points on the loan, and frequently those sunset over time. What we often see now is on a 5-year fixed rate loan, there'll be a 3% prepayment premium during the first year, reduces to 2% during the second year, 1% in the third year, and then there won't be a prepayment premium due during years 4 or 5, and the borrower can prepay during that period of time. And those are usually structured by lenders who have tried to match maturities on their balance sheets to accommodate for the roll-off of loans and the extension of new facilities. The third is referred to as a yield maintenance premium, and this one could get somewhat complicated just because of the math, but the concept is pretty straightforward. It's a formula that seeks to approximate for the actual loss of interest income to the lender. The way these are typically calculated would be how much interest would be earned by the lender between the date of prepayment and the stated date of maturity, and you would take a time value money approach to the difference between rates today and what that interest income would be at the time of maturity, and you calculate that, and that's the yield maintenance premium. What we've seen over the last few years, and what's very frequent in the CMBS world, is the concept of a defeasance payment in lieu of a yield maintenance premium. A defeasance payment allows a borrower, typically a very sophisticated borrower who has access to corporate credit lines, to be able to replace the income or interest obligation payable to its lender with a set of similarly timed and paid obligations such as treasury securities, so that the lender over the same period of time receives the interest income it would have if the loan was paid out at maturity as opposed to being paid early. The benefit to a borrower in that instance, if it's able to play the interest rate market, because the purchase price of those treasury securities fluctuates over time, and sometimes they could take advantage of the variable rate of those loans. The issue of a prepayment premium and whether and how it impacts a restructuring is something that, for the most part, is governed by bankruptcy law. And the reason I say for the most part is outside of bankruptcy, the enforceability is governed by the loan documents and state law, and it rarely comes to light in decisional law. If the documents are drafted clearly, that a payment is due upon an early maturity or an early redemption, under state law that is almost exclusively enforced, and so long as your documents provide for it. In a bankruptcy proceeding, however, there are a number of additional considerations that must be taken into account. And I want to spend a little bit of time talking about those because I think those are really the issues that drive the decision-making on whether or not the prepayment premium will get triggered. So the first consideration that gets taken into account is, under state law, how has the prepayment premium been triggered? Sounds like a pretty straightforward question. There's a lot of nuance to it, and I'm going to discuss that in just a couple of minutes. If it has been triggered, is the entire claim enforceable under state law? And then the last consideration is the entire state law claim enforceable under bankruptcy law? The bankruptcy courts, when they take a look at this, there are a number of considerations as well identified on the slide. First is, when is the premium triggered? The question of when a premium is triggered comes up in a bankruptcy because In most promissory notes or credit agreements, the filing of a bankruptcy is one of what we call automatic accelerators, and it accelerates the debt from the original state of maturity up to the date of the petition. If that causes an acceleration, the question then becomes, if the borrower prepays that debt pays that debt during the bankruptcy, is that a prepayment? And do you look at the petition date, which is when it was accelerated to, or do you look back to the original maturity date? The bankruptcy courts will also take a look at whether the debt can be decelerated post-petition. And I'm going to talk about the American Airlines case in a couple of minutes, where a very creative lending group sought to undo the automatic trigger and the automatic acceleration to be able to assert the prepayment premium. And then lastly, the court will take a look at whether the premium is a claim for unmatured interest. Bankruptcy courts have been, in the last few years, very narrowly construing the entitlement and right of a lender to prepayment premiums upon a borrower's payment during the bankruptcy or upon an exit from bankruptcy. And that narrow construction is having significant impacts because how prepayment premiums are drafted and set forth in loan documents vary widely between credit agreements, bond indentures, and the like. If your agreement does not have a specific provision that allows for the payment of the premium after acceleration, it will reduce the likelihood that it will be allowed in bankruptcy. That is the bright line test that has come out of the cases I'm going to discuss in just a couple of minutes. The other issue that we're expecting to see, as Scott talked about, this environment where we're going to continue to see the proliferation of workouts and perhaps litigation, is in a non-bankruptcy setting, whether borrowers can raise the similar issues. There are certain types of automatic accelerations in loan documents besides bankruptcy that can roll forward the maturity date, and can a creative borrower make the same arguments in a state court foreclosure proceeding, for example, and take advantage of not having to make a prepayment as opposed to a payment of that premium such as they would if it wasn't automatically accelerated. I'm going to quickly go through three recent decisions that highlight some of the pitfalls for lenders and some of the opportunities perhaps for borrowers. Very recently, just a couple of months ago, in the Southern District of New York, in the MPM Silicones case, the court denied the lender's entitlement to a prepayment premium, despite the fact that the indenture provided explicitly for a prepayment premium. However, it did not provide that the premium would be due upon an acceleration of the debt. And the absence of having that provision in the prepayment premium section of the loan agreement was the linchpin for the court to decide that the lender was not entitled to that prepayment premium because the automatic acceleration was not a voluntary decision by the borrower to prepay that loan. Similarly, in the Denver Merchandise case, which is a Fifth Circuit decision from earlier this year, I believe it was in January, the issue that came before that court was whether the pre-petition acceleration of the note without a prepayment by the borrower triggered the payment of the premium owed to the lender. Interesting set of facts, the Fifth Circuit applied Colorado state law, which is Colorado sits in the 10th Circuit. However, Colorado happened to have very specific law on the issue of acceleration and the entitlement to prepayment premiums. And specifically what happened here was the lender sought to assert that because the loan was accelerated, that the loan had to be repaid. The court said it was the lender's choice to accelerate, and the choice to accelerate was a waiver of the right to prepayment. And then the last decision was the American Airlines decision, where the Second Circuit upheld the bankruptcy court decision that also denied a prepayment premium. There, the loan accelerated as a result of the bankruptcy filing, and it also did not have the magic language that the court said it needed to have. It required the prepayment premium upon a voluntary prepayment. Bankruptcy was considered not to be a voluntary acceleration of the debt, and the court upheld the denial of the prepayment premium. And so let's talk about, on the next slide, you'll see a process flowchart when you're sitting there from either borrower or lender's standpoint. First, what was the triggering event of the default and the prepayment premium? Is the premium due notwithstanding that event? Is the premium due at any time payment is made prior to the original maturity date? And lastly, who would be most impacted by the payment of the premium? And I think the most important one to take away from this slide is the third one. From a lender standpoint, you need to have the golden language that's come out of these cases, which is that the prepayment premium is due upon a voluntary or an involuntary acceleration of the obligation, such that if an automatic acceleration occurs as a result of a bankruptcy filing and the borrower seeks to prepay it in the bankruptcy or refinance in the bankruptcy, you have the protections that it was an involuntary acceleration that occurred, and therefore you're protected.
Jay, what about the absolute prohibition against prepayment in the event of the borrower's bankruptcy filing?
There are, outside of bankruptcy, a lender has the absolute right to prohibit a prepayment. In bankruptcy, the courts have developed a body of law that allows the borrower to overcome that restriction on a prepayment. The issue is, what are the damages to the lender? And where it gets a little bit quirky for the lenders is to try to demonstrate what the actual damages are. What complicates that even further is in the normal course now, what we're seeing in the capital stack are lenders requiring swaps and other hedges to protect them against interest rate variations and other things. And if they have a swap obligation that protects their interest rate and the borrower pays off the principal balance, are they still protected in earning their income on the swap? I want to go through, and Jeff's going to chime in here on a few strategic points to consider when you're either on the borrower or the lender side and you're considering the issues of default interest, late fees, and prepayment premiums. First is understanding the strength of your legal position, the accompanying costs and risks. As Jeff has laid out and I went through on prepayment premiums, there aren't a lot of bright line tests here. That means it's expensive to litigate that issue, and there aren't known outcomes. What that means from a borrower or a lender standpoint is perhaps that means you should come to a resolution when there aren't these bright line tests. However, depending on which side of the table you're sitting on, the fact that there isn't a bright line test may lead to an outcome that might not seem rational at first, which is, why isn't somebody willing to settle this? There may be other factors that impact their willingness or ability to settle. For example, many lenders sit in a position as a fiduciary to other lenders, either as an agent or a servicer. And there are obligations they have separate and apart from whether it makes rational sense if they were the sole economic interest holder of the loan as to whether or not they should compromise on one of these legal positions. And so it's important from a both lender and borrower standpoint to understand each of those. For example, many times for example, a CMBS trust, the junior-most holder of a certificate would be the recipient of either the default interest payment or the prepayment premium. And a servicer ought to be careful when it's administering a loan in giving up that premium when it can impact a junior certificate holder's rights without either consulting them or, depending on what the governing documents are, that the borrower is not a party to, but impacts their decision on whether to forego some or all of those rights. In addition, in the market today, given that we're in a very low interest rate environment, lenders who are holding older and higher rate loans or loans that have significant prepayment premium value to them are not willing to give up easily on the issue. Just as investors are chasing yield, so are lenders, and they're always seeking a way to be able to have as much interest income or premium income hit their balance sheet. Jeff, I don't know if you want to add anything from the borrower's perspective here.
Well, from the borrower's perspective, you need to take into account whether a lender may be concerned about the timing of reporting requirements, for example, may need to get money in. It may be more important to get less money in sooner, or conversely, they may want to delay taking a write-off or taking a reduction as to an asset on their books. Sometimes it's also important, while money is typically fungible, what the money is labeled as part of a workout, because it may impact how those proceeds are divided between one or more servicers, or between servicers or investors in different tranches or at different levels. I've found these issues tend to surface in mediations, and so sometimes that's a productive way to flesh out issues such as this point. And then, from a lender's perspective, you need to evaluate the borrower and whether bankruptcy, for example, is a credible threat based on the existence of a bad boy guarantee or carve out guarantee that might actually be collectible, as well as an impact on the industry, on the particular industry, the impact that a bankruptcy may have on their business or on those on their other business. Sometimes for a borrower, getting off a guarantee or getting relief from the guarantee may be the sole motivator.
Thank you, gentlemen. Clearly, the sociology of lending and loan workouts and recovery has substantially changed over the last 2 decades, with an ever-changing landscape of players and their conflicting agendas. Mindy Mora will next be discussing the impact those players and agendas may have on loan workouts. Mindy has been handling financings from cradle to grave, so to speak, for the past 32 years. We're especially delighted that Mindy was just recently elected to be inducted into the American College of Bankruptcy. Mindy.
Thanks, Scott. In this next section, we're going to be covering how workouts are affected by third-party issues such as intercreditor agreements and what it means to have lien or payment subordination, and also how a workout can be impacted by statutory liens and by guarantee liabilities. Although intercreditor agreements have been around for many, many years, there's been a real resurgence in second lien lending during the early to mid-2000s. At that point, the lending involving second liens grew because of a recognition that the borrower's enterprise value was often greater than the amount of debt secured by the first lien loan. And so the second lien lenders looked to the equity in the business to collateralize their loans. The first lien lenders generally were willing to permit this subordinate financing in order to facilitate the growth and success of their borrowers' business goals. So let's review who the typical parties are to an intercreditor agreement. Usually the first lien is held by a traditional bank or a commercial finance company that has a first lien on all the assets of the borrower, while the second lien is often held by a private equity group or a hedge fund. The first lien holder's objective is to always maintain control and a senior position in the borrower's capital structure. They want to exercise control over rights and remedies against the collateral. They want to ensure a first lien on all the assets and a first priority claim to any excess cash flow. And they also want to make sure that they maintain control if there is a subsequent restructuring process that is commenced against the borrower. The second lien holder's objective in negotiating the intercreditor agreement is to retain the ability to exercise certain rights and remedies upon triggering events during the life of the loan, and at a minimum lock in its position and exposure at the time that it enters into the intercreditor agreement. The next fundamental concept we're going to cover in order to appreciate what's at play in negotiating and evaluating an intercreditor agreement is the concept of lien subordination versus payment subordination. Lien subordination involves a situation where two creditors have security interests in the same collateral, or what's often referred to as common collateral, with one of them having a stated priority of their lien over the lien held by the other lender. The intercreditor agreement often addresses payment subordination as well, especially if the lenders share identical collateral. And what payment subordination means is that one creditor has the right to be paid to some extent first from the assets of the borrower or any applicable guarantor, irrespective of whether those assets also collateralize the subordinate lender's loan. Now, a payment subordination provision in an intercreditor agreement normally addresses limitations on excess cash flow payments, and first lien lenders in negotiating intercreditor agreement often seek to impose express limitations on those excess cash flow payments. Typical limitations only permit the payment of excess cash flow to a junior lien holder if no event of default has occurred and is continuing, if the borrower has excess availability, and if the borrower is in full compliance with its financial covenants. So the issue of common collateral and the composition of the first lien collateral is something that is clearly addressed in every intercreditor agreement. Often the parties have valid protected security interests in the same collateral, and one of the issues that comes up is when that collateral is exhausted, when there is a liquidation, there is an issue as to whether the second lien holder's claim is paid pari passu with that of the first lien holder when they are seeking to recover any deficiency, or whether the second lien holder's claim is senior in right of payment. It's critical that the parties in the intercreditor agreement explicitly define the types of first lien obligations that have the benefit of the subordination provisions in the intercreditor agreement. This is also known as the first lien cap, and we'll cover what that means in just a moment. As a result of these concerns, when parties are negotiating intercreditor agreement, what they commonly do is they seek certain protections of their rights. There are certain rights that are common that both the first and second lien holders seek to limit as to the other lien holders' abilities to exercise both before and after a borrower defaults. For example, pre-default, they want to know that neither lender can do significant amendments of its loan documents without the consent of the other lien holder. This would include increasing the interest rate, other than, of course, the ability to impose an agreed-upon default interest rate. They want to know that the other lender is not going to extend the scheduled maturity date. They want to know whether or not there's going to be any modifications of any covenants or events of default that restrict payments. And they certainly want to prohibit an increase in the principal amount of the debt. But there are also different protections that are important depending on whether you're the first or second lien holder in an intercreditor agreement. We'll turn to those next. The unique protections that are often sought by a second lien holder would include a limit on the first lien cap. And what that means is how much of the first lien holder's debt is going to be protected by the first lien. And how is that going to impact a workout? Well, let's first talk about what a first lien cap is. The first lien cap means how much of the senior lien holder's claim is going to be protected by a first priority interest in the collateral. And that can be structured in a number of ways. There can be a dollar limit. It can be tied to some percentage above a borrowing base. That's a percentage of, for example, in a personal property loan, receivables and inventory. Or it could be a combination of the two and be the greater or lesser of the dollar limit and borrowing base. The first lien cap generally focuses on as well what the components of it are. For example, the lender normally is entitled to recovery of its principal plus interest, costs, and fees. Now, it's not always the same provisions with respect to advances. Clearly, a lender is entitled to make protective advances, for example, to pay off real estate tax obligations that would prime the first lien lender's lien position. But if the first lien lender, for example, knowingly makes an over-advance, that's known as an intentional advance, and often that's not included in a first lien cap, and because of that, it may impact the ability of a borrower to obtain an over-advance from the senior lender. The first lien cap may also include bank product obligations such as cash management services or hedging obligations. It may also include DIP financing in the event of a subsequent bankruptcy filing by the borrower, and it may also include the accordion limits, that is the increased lending limits if a dollar limit approach is used by the senior lender. The critical takeaway here is that the ability of the first lien holder to advance funds can be adversely impacted in a workout if it's not going to be able to include those additional advances in the amount that's covered by the first lien cap. The second lien holder is also going to want to have the option to purchase the first lien debt, and that's going to be subject to some triggering event like the acceleration of the first lien debt or enforcement action by a first lien holder, commencement of a bankruptcy proceeding. The second lien holder may seek to add additional items as well, events such as a payment default under the second lien documents, the first lien holder refusing to make advances under its loan documents, or the notice of a disposition or enforcement action by the senior lender that would force a lien release by the second lien holder. The intercreditor agreement is also going to address the terms upon which the first lien debt can be purchased. For example, is it at par, and is it all the debt owed to the senior lender, or only the debt that is secured by the first lien priority? Now let's turn to the typical protections that are usually sought by a first lien holder in an intercreditor agreement. The most critical thing, of course, is the concept of standstill provisions. The senior lender wants to make sure that enforcement activities by the second lien holder are limited. So the triggers normally giving rise to a standstill, in addition to obviously any activity by the first lien holder, is that the second lien holder there may not be a default by the first lien holder in the first lien holder's documents, but there could be a notice given by the second lien holder that a default has occurred under its documents. And so that may give rise to a standstill obligation as well. Normally that standstill period is 90 to 180 days, plus any ongoing diligent enforcement activity by the first lien holder. There are some exceptions to standstill by a second lien holder, and these have to be carefully reviewed, and at the time that an intercreditor agreement is being negotiated or a forbearance agreement is being negotiated, carefully reviewed at that time as well. The second lien holder usually is allowed to file a suit for non-payment, but can't exercise any judgment that it obtains. It can normally file a proof of claim or a response of pleading in opposition to an action contesting the claims of the second lien holder. It can file an action to protect or preserve its lien in the collateral, so long as it's not taking a position adverse to that of the first lien holder. And in any judicial foreclosure action initiated by the first lien holder, it can normally join in that action as long as it doesn't hinder, limit, or delay the enforcement action. But in connection with insolvency proceedings, that's sort of where the rubber hits the road. Normally, an intercreditor agreement will have an express prohibition on the second lien holder commencing or participating in commencing the proceeding. In addition, the first lien holder is going to want to limit voting rights in bankruptcy. Generally, the second lien holder's voting rights are going to be limited, and the second lien holder will not be able to exercise voting rights unless it's voting for a plan that provides for payment in full of the first lien holder debt, or the first lien holder otherwise approves a plan that's up for consideration by a bankruptcy court. This generally means that the second lien holder can't vote against a plan that's supported by the first lien holder, but recent cases have challenged this position. On the slide, you see the first case that we cited to is In Re TCI2 Holdings. This was a case involving 3 Trump casino hotels in New Jersey where there were competing plans, one filed by the first lien holder and another plan filed by the debtor that the second lien holder supported. The debtor's plan ignored the payment subordination provided for in the lender's intercreditor agreement, and the court found that nonetheless the debtor's plan could be confirmed, notwithstanding that it violated the terms of the intercreditor agreement, and that was because of an interpretation of the bankruptcy code that accepted out the impact of the subordination agreement provisions when a court considers confirmation of a plan. Does a second lien holder set itself up for a breach of contract claim if it becomes a co-proponent of the plan or a supporter of the plan? Well, in the case that Jay cited, MPM Silicones, in another reported decision, Judge Drain of the Southern District of New York Bankruptcy Court granted a motion to dismiss that was filed by the second lien holders to claims brought by the first lien holders under an intercreditor agreement, and it found that the second lien holders had no liability for breaching the intercreditor agreement, notwithstanding that they entered into a support agreement with the debtors with respect to the debtor's plan. They supported the debtor's objections to the make-whole premium that the first lien holder sought, and they also supported cramming down the plan or getting it approved over the objection of the senior lien holder. In addition, the junior lien holder received a reimbursement of its professional fees and a distribution of common stock under the plan, and the court said that didn't violate the intercreditor agreement either, because the second lien holder also had rights as an unsecured creditor, and they were entitled to act in their own capacity as an unsecured creditor. But this area of law is not settled, and with a different kind of intercreditor agreement, in fact, a more tightly drafted intercreditor agreement, other courts have held that the second lien holders could be prohibited from taking these exact kind of actions, and I cite you to Erickson Retirement Communities at 425 BR 309 as a recent case that went exactly that way. Now, another area of impact on workouts is the existence of silent or statutory liens. An example of these are landlord liens that exist under state law in a number of jurisdictions, and mechanics liens that can be asserted as well by parties who are working on property, for example, or in possession of the debtor's property, and state law governs the priority of those mechanic liens as well vis-a-vis the mortgage debt. By way of example, Florida Statute Section 8308 provides for a superior lien in favor of a landlord on personal property that's brought onto the landlord's premises or is otherwise owned by a tenant before a security interest is granted to the lien holder. Likewise, in Texas, the duration of property on premises is a factor in determining the priority of the mechanics lien. Many other states have similar provisions, so the issue to check is, in connection with landlord's liens, whether the secured lender obtained a waiver of that lien in connection with documenting the loan. Of course, once bankruptcy is filed, the issue of a landlord's lien becomes really a null issue because Section 545 of the Bankruptcy Code invalidates statutory liens for rent. The issue of mechanics liens, though, can be a real significant issue in a bankruptcy case as those continue to survive, and the impact of those under state law must be carefully evaluated in analyzing rights under a workout. The last area I'm going to talk about is the area of carve-out guarantees, which Jeff briefly mentioned before in his remarks. As contrasted with a full recourse guarantee, a carve-out guarantee normally contains bad boy provisions that trigger recourse for a guarantor either partially or fully based upon particular events. Partial recourse carve-out liability is usually imposed when there is misappropriation of rents or insurance proceeds and is solely to the extent of the lender's actual losses arising from those acts. Full recourse carve-out liability, on the other hand, is usually imposed for certain intentional acts, such as the voluntary filing of a bankruptcy petition. In the last several years, there's been a great deal of discussion about a recent case in Michigan known as Cherryland. In this case, there was express language in the bad boy guarantee that required the borrower to remain as a special purpose entity and therefore remain solvent paying its debts as they came due. Of course, the borrower became insolvent, and the lender sued on the bad boy guarantee based upon this trigger of insolvency, which occurred without any overt action or fault by the guarantor. In response to the Cherryland decision, in which the court found that the guarantor was liable because the borrower became insolvent, the Michigan legislature passed the Non-Recourse Mortgage Loan Act, the NMLA, which retroactively made reliance upon the breach of a post-closing solvency covenant to impose recourse liability as simply unenforceable on the grounds that it's unfair and deceptive and against public policy. The Michigan Supreme Court subsequently remanded the Cherryland case to the Court of Appeals for reconsideration of its decision in light of MLA. We don't have a final decision yet, but Wells Fargo has argued that the guarantor waived that defense, that the NMLA was unconstitutional and could not be applied retroactively, so stay tuned for the results of that decision. If you're in other states, public policy is going to be a factor, and there may not be legislation as clear as that of Michigan. In other states, guarantors have argued that the bad act has to be commensurate with the triggered full recourse liability. Many courts have agreed, but have also upheld the policy that contracts between parties that are freely entered into should not be interfered with by the court. We've cited two cases on this slide that look at both sides of this issue and came down with different conclusions on the issue of guarantor liability when the only breach is the insolvency of the borrower. So what's the takeaway to guarantors? In terms of our advice to guarantors, you need to verify the scope of the guarantee provisions which impose liability and determine if the liability is for the lender's actual losses or for full recourse. You have to know this in order to fairly evaluate the consequence of both the borrower's actions and the guarantor's actions during a workout. The guarantor is going to vote its shares in a borrower's equity in order to force the borrower into a bankruptcy proceeding in order to try to preserve its equity. It has to know, the guarantor, that that's going to be imposing full recourse guarantee liability likely on the guarantor. You need to determine if the applicable jurisdiction where the guarantee is going to be enforced has enacted legislation like Michigan's NMLA or otherwise whether there's favorable case law in order to avoid liability solely because of the borrower's insolvency. If the lender does seek full recourse against the guarantor should be prepared to argue in its defensive papers whether the lender's actions have been commercially reasonable, the need to avoid an absurd result, and what the actual intent of the parties was in negotiating the guarantee. And finally, if you're at this stage in the economic cycle where you're negotiating a new carve-out guarantee, please make sure it has clear, well-defined definitions. Also, carefully craft the carve-out within the body of the guarantee itself rather than by incorporation by reference to the other loan documents, as that's going to make you focus on the exact situation where full recourse liability is going to arise. You need to think about the borrower's intended business operations and how its debt, expenses, and potential liabilities could impact the guarantor's liability. And finally, you need to be aware of the distinction between debt and the failure to pay invoices when due in light of ongoing disputes that the borrower may have with its creditors and the potential for involuntary liens that could arise in the borrower's business.
Thank you, Mindy. And thank you to our audience for joining us today. We certainly hope that you found the program useful and informative and that you'll join us for future programs in our General Counsel series. If you have any questions regarding the content of the program and the presentation of our speakers, please feel free to contact any of the speakers by email, and we will be certain to respond. This program will be posted to our website at www.bilzen.com. You may likewise access other programming produced by Bilzen from our website. We wish all of you a happy and healthy holiday season.
That will conclude our call for today. Thank you all for your participation. You may now disconnect.